Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. My name is Lakshay. Welcome to my Zoom meeting. We do this every Tuesday on real estate and taxes. And today's topic, we want to focus on how do we value a food business. A lot of you guys are realtors. A lot of you guys have investor clients or clients that are looking to buy a brand new business. So today's topic, I wanted to shed some light as to what are some of the things that you want to look at before buying a food business, whether it be from the accounting perspective or from a layman's perspective on real estate. How do we value a business and how can we actually make the right decision? So today's topic will give you some insight in terms of what should be looked at when you're purchasing a food business. So here's a quick checklist of what needs to be done. Number one would be having a third-party appraisal. Number two is getting a review engagement with an accountant. Assessing how long does it take to get the money back on the money that you have invested. What are some of the lease arrangements that they have on the property as well as on the machinery, and do a quick payroll analysis on how many employees are required to run the business. So first things first, let's look at a business valuation report of this business that I have picked up randomly. So this is actually a food business right now that is operating, and these numbers are just examples. So right now we have technically 2022 and 2021 numbers. This business is technically making 436 in revenue, and after some of the purchases of food, you're left with roughly 236,000 of gross margin. Once you pay out your employees, your utilities, your rent, you're left with roughly there's $73,000 worth of total expenses, and you have, after paying yourself $100,000, you're left with $52,000 in net income. So now you must be wondering, how do we look at this statement, and from the non-accounting perspective, how do we make sure that this is the right business to buy or not? Just a couple of things aside, in 2021 there was COVID, so the numbers were really low, and as we are hitting the back to business, and 2022 has been fully back in business, they are reaching their revenues back up. So a business valuation report would be done by, let's say, a third party, and what they would want to determine is how much or how is the business valued. So you would want, whenever you're buying a brand new business, whether it be food or whether it be any other business, you would want to get a third party appraisal done. In that third party appraisal, technically what they do is they look at the net income and they do a multiple. Let's assume for food industry, net income is 52,000, 4.5 times the multiple would work out to 235,000. So that is technically what the business should be valued at in this scenario. So if we were to go in blind and if we wanted to buy a food business, what you want to look at is what is their net income, and at 4.5 times the net income, what is the value. And in this scenario, it's $235,000, but in essence, in real life, they're asking for roughly over $600,000 of. They're asking for roughly $600,000 to sell their business. So just from the get-go, you can see that the business seems a little bit more overpriced, because from the revenue numbers, we can see it is only churning out $235,000 in net income, which is 4.5 multiple of current year, and they're asking for far above this, which is $600,000. So how do we make sense of this? Let's look at some of the other things to make sense of the 600,000 number that they have provided. The second thing that you want to look at is the financial statements and tax statements. We all have financials, tax filings, HST filings, payroll filings that we do on a month-to-month, quarterly, as well as annual basis. So before buying any business, you want to spend some time. You want to spend some time with their bank statements. How much is the revenue coming in? In the past, we have also seen, just before the selling of the business, people moving money from their savings account into the business just to show that the bank statement supports very high revenue, which might not be true. So you would want to involve an accountant to get a review engagement done. In essence, what they do is they try to do the revenue verification, looking at the bank statement and then tying it to the invoices. They also look at the HST returns that are filed in the past. What they would try to do is, what are the sales, how much were the purchases, and how much is the net HST that is being remitted by the business. So that would give you a bit more comfort. And in the past also, what we have noticed is a lot of people are, who are looking to buy a Subway or looking to buy a franchise, the food cost is roughly, 30%. So if you have a statement that is showing the food cost of 12%, clearly the statements are, basically fixed per se. So you would want to have someone, a CPA, to look at those numbers as well. Now that we understand how to look at the third-party appraisal and financial statement and tax documents, the third thing we want to consider is the manpower evaluation. What do I mean by manpower? I mean to say that how many employees are needed to run this business. So in this scenario, in our example, we have some salaries and wages over here, which is $140,000. Currently, they're operating with 6 employees, and that's what they have said to, we need 6 employees at least to run the operations normally. But if we do our analysis, how many do we truly need and how much is it really paying? So I did some quick math. Monday to Friday, they were open 10 hours per day. So that works out to 50 hours per week. Times that by 52 weeks, they're open all year round. So 2,600 hours that you would need to pay as a business owner out of your pocket. There might be $30 per hour employee. There might be $15 per hour per employee. So how do we really look at the average? I tried to look at it from the perspective of the lowest cost, which is $15.50, which is the mandatory wage rate for any worker that you hire. So what I did quickly was I looked at their current salaries that they're paying of $140,000 divided by the number of hours I need people on the show. So that worked out to $54 per hour. Now in $54, how many $15.50 people can I accommodate? So $54 divided by $15.50 works out to 3.5 employees. So if I'm buying the business, I might have me and my wife working as well. So over there, you might only need additional 2 employees. So 2 would be me and 2 more employees would be hired. So roughly 3.5 to 4 employees is you need to run or operate this business successfully. Now let's look at how long it takes to make the money back. What I try to do with the normal income statement is I try to add back any of the costs that can be controlled. In this scenario, number 1 would be depreciation, number 2 would be management salaries, and over here, and number 3 would be any taxes that are paid. So in the $52,000 net income, if I add back the $1,600 depreciation and the $100,000 management salaries, because management is technically the business owner. So I can pay myself $100,000 or I can pay myself 0. Like in prior year in 2021, you can say there was not enough income, so they didn't pay themselves. So it's totally at my discretion how much I want to pay myself. So because it's so variable, I'm gonna add that back and give them the benefit of the doubt and come up with a new number. In this scenario, the 52,000 became 154,000 after adding back the management salary as well as depreciation, because those are not really the fixed costs, those are variable. So if I now do 4.5 or 4 times the new net income that I've come up with, it's working out to 616,000. Now if you look at it, it almost starts making sense. They were asking for roughly 600,000 to buy the business, and now after adding back all of the expenses that are controllable or maybe made up, we can technically look at the business valuation is more closer to 600,000, which is what the asking is. Now if I go one step ahead, if I've invested 600,000 in a business, how long does it take me to make the money back? Usually I look at a rule of thumb of 5 years. So in 5 years, if I've invested something, I should be able to make back within 5 years all of my investment. So in this scenario, if the net income is 150,000 per year, in 5 years I can make back 770,000, which works out to far more than what I have paid. So all of a sudden, now if you ask me, from saying that hey, the business is not that great, it's only making $50,000 in revenue net income, now my answer has kind of changed towards hey, this business might be worth a shot because it's making a significant amount of profit. It is a positive cash flow, so we can certainly look at that at a $600,000 mark. Now we have evaluated the manpower, how many employees are needed. We've evaluated, we can make the money back within 5 years of the running the business. We have recalculated the net income. The fourth or fifth thing I want to evaluate is what is the current lease arrangements. Are we looking at a lease that has almost coming its end time, which is nearing its termination, or is it going to be renewing soon? If it is renewing, what would be the renewal rate? Is the lease in our scenario, the monthly rent is very low because the yearly is 25,000. That means it's a fairly low rent cost. But are they gonna revise this rent by 3%, which is what the market is, or are they gonna revise it by double because the interest rate has increased and things have become a little bit more unaffordable? I've had other businesses and rent has been the biggest expense on their books. In this scenario, the rent is really low, so again, a plus point for the business. But once again, you want to look at what is the rent roll, what is the term of the lease. Is it 5 years? Is it 10 years? Whenever you buy food business, there is some equipment. There is hood, which is sometimes the cost of repairing a hood can be significant. So you want to look at that machinery as well. You'll want to look at the lease on that. Is it purchased? Is it leased? If it's leased, what is the term end? Is there any warranty attached to it? So those are some of the things you want to look at in order to finally assess that, hey, this business really makes sense for me and my family, or it doesn't. So in conclusion, when we started off the presentation, we noticed that the business was making only $235,000, even if we did 50,000 times 4.5 multiple, which is far lower than what their asking price of 600,000 is. But when we did the manpower calculation, when we recalculated the profit, the business became a little bit more positive. Why? Because the business owner saying they need 6 employees to work at one time, whereas we calculated it can suffice with 3.5, and if I include my family, husband and wife working in the business, that 3.5 will become 2.5, right? Or maybe 1.5 additional employees that is needed. We also re-added the depreciation, as well as we re-added the management salaries that the company was paying, the business owner was paying themselves. That profit became really, really good at that time. So $150,000 was the new profit times the 4.5 multiple. It became closer to what the asking was, which is 600,000. We also did another analysis that how long it would take to make the money back. It was roughly 4.5 years to 5 years. We were able to recoup all of our investment. Any good business should be able to make all of the money back that you have invested within the 5-year mark. My conclusion would be, in this dummy statement food business, I would say it's a good buying decision, whoever wants to, and they should definitely consider.